Hello, my friends. Today is April 13th, and this is Markets Weekly. So, this week was a pretty turbulent week in markets. Seems like the CPI and ongoing geopolitical tensions really spooked the market. But zooming out, I noticed that we seem to find pretty good support at the 50-day moving average for the S&P 500, and I bought the dip there. Let's see how that turns out. If I think nothing bad happens over the weekend, I would expect a pretty strong relief rally on Monday. Okay, so today I want to talk about three things. First, we have to talk about all the inflation data we got the past week that really seemed to spook the markets. Secondly, I want to talk about how even though it looks like inflation is sticky above the Fed's target, the Fed is going to still cut rates this year, and personally, I still think about 3 cuts. And lastly, I want to talk about this review Bernanke did on the Bank of England. So over the past few years, central banks did not do their forecasting very well. The UK government wanted to improve the Bank of England, so they invited rockstar central banker Ben Bernanke to help them out. Let's see what Ben's report found. Okay, starting with inflation. So this past week, we got 3 inflation data points. First, we got CPI, which was the most important print. Secondly, PPI, somewhat important. And lastly, import prices, much less important. Now, CPI was higher than the market expected and all around not a very good print. Now, when you look at CPI month over month, either core or headline, what you see is that at a month over month level, it looks like CPI bottomed sometime in the fourth quarter of last year and has since then somewhat accelerated. Now, to see this more clearly, we can also look at CPI at a 3-month, 6-month, and 12-month annualized rate. Now, what you see is that CPI is notably accelerating in recent months. The 3-month annualized rate is comfortably above 4%, which is really not good. Now, let's zoom out even more. And let's look at CPI annualized over the past few years. Now, what you notice is that CPI absolutely surged in 2021 as we were dealing with all that high inflation, and since then came down a lot, but didn't come all the way down to where it was pre-pandemic. It seems to have stabilized somewhere around 3.5%. Now, the market looked at this and really didn't like what they saw. It seems like the market was really buying into all this steady disinflation, but now finally the market is beginning to realize that inflation seems to be somewhat sticky above the Fed's target, and so it had major implications on asset pricing across the market. First, let's look at short-term interest rates. So the market now is pricing in just 2 Fed cuts this year. In contrast, as recently as March, the Fed themselves guided towards 3 cuts, so the market is being notably more hawkish than the Fed. Now, fewer cuts, of course, is also going to have impacts on longer-dated interest rates. The U.S. 10-year yield surged this week to above 4.5%. There's a little bit of a retracement, seemingly on the back of geopolitical fears, but it is a pretty big move over the week. And of course, it also got a strong bid for the dollar. Now, when you're looking at the dollar, it's not just what the Fed does, but it's also about what other central banks are doing as well. Now, we did have other central bank meetings this past week, and it looks like the market is becoming more comfortable that the ECB is going to cut in June. So just as the market is becoming less confident of a Fed cut in June, it's becoming more confident of an ECB cut in June, and that widening interest rate differential is strengthening the dollar. Looking over the past week, it looks like the Dixie, the dollar index, strengthened notably. Looking across the world, you can see that the higher U.S. 10-year yield is, of course, also placing upward pressure on sovereign bond yields in other countries. Say Japan saw the 10-year JGBs, notch up a bit this past week, and you did see the Japanese yen weaken past that 152 soft ceiling that the Japanese authorities have been warning about. See them slightly poking its head above that. There was no intervention, just more stern words. Again, eventually, we're going to have to see the Japanese authorities do something, or I think this could really run higher. Now, eventually, I would think that higher yields and a stronger dollar is going to be a headwind for the U.S. economy, and for risk assets, but probably not at this level. As I recall, last year the markets really didn't like it when the 10-year yield hit 5%, and we're still quite a bit below that. Now, secondly, we got other inflation data as well. PPI was a bit softer than expected, and that seemed to calm the market quite a bit. And lastly, we got import prices, which was hotter than expected, but really, I don't think anyone pays attention to that. Now, related to that, the next thing that I want to talk about is how I think that even though inflation seems to be stickier than expected, I still believe that the Fed is going to cut rates, and probably 3 times this year. Well, first off, when you're looking at inflation, it's important to note that there are many different ways to measure inflation, right? We got CPI, you also got third-party private measures like true inflation and so forth. When you're talking about the Fed, what you want to focus on is the inflation measure the Fed cares about. And that's not CPI, it's PCE. Now, PCE and CPI both measure consumer inflation, but they measure it in different ways. If you're interested in learning more about this, I would highly recommend the Odd Lots episode with Omar Sharif that breaks it down for you. Among the many different differences, for example, CPI tends to measure consumer out-of-pocket expenses, whereas PCE would be broader and also capture expenditures on behalf of the consumer. For example, when you go to the doctor, let's say you see the doctor and you pay your copay, and then you go home. Now, the copay is your out-of-pocket expenditure, so that's what will be captured in CPI. But of course, that's not the end of the story, because your insurance company then also makes a payment to the doctor on your behalf. That payment on your behalf would also be captured by PCE, so it's broader. And again, you have different things like weights. Shelter inflation would be higher. Shelter would get a higher weight in CPI and a lower weight in PCE. So historically speaking, PCE and CPI, they move in the same direction. But if you look at what's been happening over the past couple years, you notice that CPI and PCE have diverged notably. In fact, that wedge, whereas CPI is historically higher than PCE, has widened. And so looking at, say, CPI stuck at around 3.5% doesn't really give you, isn't really what the Fed is looking at. The Fed is looking at PCE. So what's PCE at? Well, we don't get PCE until later in the month, but the Cleveland Fed has a PCE forecast based on the latest data, such as PPI. Now, if you look at the Cleveland Fed's forecast, you'll note that they actually have PCE coming down over the month. And PCE, it looks like core PCE is about 2.5%. So that's pretty close to the Fed's target. And you can see that if the Fed is looking at inflation based on PCE, and they're seeing that, it's getting really close to target, obviously they're going to be thinking about cutting and definitely not thinking about hiking. That is, in my view, just totally not in the cards. Now, another way that you can see how the Fed is thinking about this is just to listen to what they're saying. So we got a lot of Fed speak the past week. But when you look at Fed speak, you got to be careful. There are a lot of people on the Fed, but they are not of equal importance. The most important speaker that we got the past week was John Williams of the New York Fed, and he's just talking about bumpiness in the inflation path, which is basically what Chair Powell has been saying also. So these guys, they're looking at this inflation data and they're just telling you that it's bumpy. And so that suggests to me that they're not really changing their core view. And what's their core view? Well, we also got the Fed meeting minutes on Wednesday, and it's very clear. Fed meeting minutes are telling you that everybody thinks, almost everybody, and I think we know who that one person who doesn't agree thinks. Almost everybody thinks that we're going to be cutting this year. Could be cutting 1, could be cutting 2, could be cutting 3. Now, on March, the guidance was 3. Maybe that's changed. I still expect that we would get 3 simply because going forward, it does seem like the Fed is more concerned about over-tightening. And I think the odds are that going forward, we would probably hit some kind of air pocket, either in the employment data or just simply because of just some self-patch in the economic data. And I think that would rapidly change the the market's pricing. But we'll see how that plays out. Okay, the last thing that I want to talk about is Ben Bernanke's review of the Bank of England. Now, for those of you who know a bit of history, this is kind of a sad moment. So, for hundreds of years, the Bank of England was London, the UK, Great Britain was the financial center of the world. Again, Bank of England, a big player in that space, and now today. They're inviting a foreign central banker to come to teach them how to do their homework. So what happened was that over the past few years, the Bank of England's inflation forecasts have been really wrong. And the government, in order to have some more accountability, hired Ben Bernanke to come and just do a review and see how the Bank of England could improve. Now, to be clear, everyone's inflation forecast was really bad the past few years, including the Fed. And so it's not too fair to pile in on the Bank of England. Economic forecasting, honestly, I'm not sure if anyone takes that stuff seriously, but they were no worse than anyone else. But let's see what Ben Bernanke found in his review. Now, the most salient thing that he found that I thought, and the first thing he listed was that the Bank of England's systems are really not good. It seems like Ben Bernanke showed up, being an economist, he wanted to say, hey, what does your day look like? All right, let's pull some data, let's run some regressions, let's see what happens. And it seems like Ben was really shocked that, oh my gosh, these databases, they're so slow. The software is so out of date. There's many things that I'm used to doing that I can't do. And he seems to be very surprised. So at the Fed board in DC, so they have actually really good data. In my experience, they have a very good mainframe, and you just type in what you want in SQL, and you can get the data downloaded very, very quickly. So across the Fed system, so they do have good systems, and it seems like they don't have that in the Bank of England, and so Ben was pretty upset about that. Now, for some context, though, the Bank of England is really not a well-funded organization. Now, if you, for example, are a newly minted PhD and you get a job at the Bank of England, and you can look at this public data, the starting salary is like £60,000, which in dollars is like $75,000. A new PhD at the Fed board would be starting more like $150,000 to $200,000 a year, depending on your specialty. So, Fed board guys are making twice as much there as they are at the Bank of England, and London is much more expensive than Washington, D.C. So the Bank of England definitely doesn't have a lot of funding, and so that may explain why their systems are not as good. But I think conceptually the most important critique that Bernanke made in his findings was that the Bank of England's communication strategy could benefit from some updating. So let's actually, for some context, let's see where Ben is coming from. So again, at the Fed, the way that the Fed communicates to the market, many press conferences and stuff like that, but a big way they communicate is through what's called the dot plot. And if you look at this dot plot, what happens is that everyone on the FOMC is giving their best guess as to where interest rates will be over the next few years, and conditional on that path of policy. So saying that, hey, if we adjust interest rates according to what I think we should do, this is what growth would be, this is what unemployment will be, and this is what inflation will be. So that's how the Fed communicates to the markets how they're thinking and helps guide the markets. Now, the Bank of England does something that is really different. That they also publish forecasts like all other central banks, but their forecasts are not conditional on what they think the rates will be. Their forecasts are conditional based on market expectations. So what they'll do is they'll look at the market and say, well, what's the market pricing in right now? Okay, I'm going to use that as an input in my model, and this is my forecast. So Ben was saying that, this is not super useful because it doesn't actually help the market understand what the bank is doing. So again, for example, let's say that you're the Bank of England and the market is pricing in, let's say, 5% interest rates for the foreseeable future. And based on these 5% interest rates, you forecast deep recession and inflation coming down, and that's what you present in your policy report. But let's say that you are a Bank of England and you think, well, this market expectations of interest rates much too high. That's ridiculous. Obviously, I'm going to be cutting rates, so the market is wrong. Now, if only I can do something about that. Well, I'm the central bank. Obviously, I can do something about that, right? So all you'd have to do is to just communicate to the market that maybe you're pricing in not enough cuts because I think that interest will be lower. And if the market were to do that, if you take that and feed it into your model, then maybe you get a very different forecast. So what Ben Bernanke is recommending is that maybe the Bank of England, give a little bit more, give the market a little bit more sense as to how they are thinking about what the path of policy is, because that's so much more useful. That could communicate to the markets as to how they should be pricing interest rates, and that that could change your forecast dramatically. And so basically, if the market and the Bank of England are not in step, these forecasts don't help the market get more in step, and these forecasts become useless because the market's expectations are wrong, because the Bank of England is actually not going to behave in that way. Now, a second critique that that Ben leveled is that the UK usually publishes what's called a fan chart, where they have, forecasts are uncertain, and so they would give these really wide fans to give you a sense as to just how uncertain they are on these forecasts. So Ben was looking at this, and it's like, based on conversations and looking at the methodology, these forecasts, these bands don't really make a lot of sense. It seems like a lot of times they're just, made upon human judgment. And so they're not really telling you a lot. He recommends that people get rid of these fan charts altogether, simply because they're just not methodologically sound. And the fan charts are something that the Bank of England has been doing for a couple of decades, I believe. So that seems to be a pretty big change. Now, I have no idea if the Bank of England will implement any of these changes, but it looks like, oftentimes when you hire these consultants to come in, it looks like they just kind of want cover to do changes that they already want to do, or maybe this was forced upon them by the government. In any case, it looks like this is probably going to lead to some change. Hard to know exactly what that change would be. So let's see what happens. Probably do this slowly. Public institutions are quite slow. All right, so that's all I prepared for today. Thanks so much for tuning in. If you're interested in my writings, check out my weekly blog, fedguy.com. This week, I will talk about just how the dynamics of the April tax strain work. And if you're interested in learning more about markets, check out my courses at centralbanking101.com. Talk to you all next week.